So I'm Rebecca, and Sam is obviously there on the line with me, and we wanted to deliver this masterclass because we understand that there can be a lot of complexities when it comes to mastering your business expenses, pensions and income. So we're going to hopefully make it really quite simple for you to digest some of these key elements, both in your business and in your personal financial planning. So first of all, we're going to go through just a brief summary of the difference between an accountant and a financial planner and how they can support you in your business and personally. We're then going to dive right into business expenses and how you can master those. I will then be touching upon pension planning and income protection. So there are obviously a lot more areas when it comes to supporting your business and personal life financially, but we wanted just to kind of focus on these 4 key topics during this masterclass. So hopefully you come away with some really easy to implement practical tips and guidance. So I'm just going to pass you on to Sam now, who's going to tell you all about how amazing she is as an accountant and what she does for her clients.
So, hi, I'm Sam. So basically I help female business owners with all of their accounting and financial needs. I started my business last July, so I've been over a year now. And before that, I worked in the corporate world in accounting for like 18 years. Had 2 little girls who are like 2 and 3, so that didn't really work with the flexibility I needed for my kids. So I set up on my own and I am loving it. So as well as being an accountant, I have a complete obsession with shopping and clothes and reading. I literally read, I think I'm on about 24 books so far this year. So that's a bit about me. And then we were just going to go on now, aren't we, to explain what an accountant does and what the difference between me and Rebecca, because I think a lot of people get confused and seem to think I know all about pensions when that clearly is Rebecca's speciality. So basically an accountant can help you with like all the compliance side of things in your business. So I tend to help people a lot with their year-end accounts if they're a limited company and getting everything filed, and the corporation tax as well as personal tax returns, as well as doing all the compliance work. Then accountants can help you a lot with bookkeeping, forecasting, sort of anything to do with trying to hit certain goals and knowing how you're going to get there, so budgets and that sort of thing. And we can help with the tax savings and the best way to set up your business and structure it, whether it be a limited company or a sole trader. And then I'll let Rebecca tell you what she does.
Yeah, so as a financial planner, I'm there to help you kind of make your business work that little bit harder for you so it can enable your personal lifestyle. So if you've got personal goals that you want to achieve, and obviously your business income, your business profits is the main thing that's driving that personal lifestyle, what we can do is put a plan in place to help you achieve your goals, utilising your business. And if along the way that requires implementing financial vehicles such as a pension or a protection policy, then as a financial advisor, I can make those recommendations and implement the plan or the policy for you. So really, I'm here to kind of help you see what's possible, make a plan, and then put it in place. So we're going to just jump now into the actual detail of the masterclass, but please ask any questions as we're going along, because we want to make this as informative and as interactive as possible, so you come away with as much information as you may need at this point in your business journey.
Right, okay, so we'll get started. So I'm here to talk about how you can minimise your taxes by maximising your expenses. So I'll give a brief view, and then that's me again, but you already know who I am and what that says. So just a little disclaimer, so this is all just for information and guidance purposes, and it does not constitute financial advice, and everybody's personal circumstances are different when it comes to taxes, so you are best speaking to an accountant if you're not sure if it actually relates to you, but the majority of these expenses will be in most people's businesses. So the best place to start is, what are allowable expenses? So I think the easiest way to think about this is, are the expenses wholly and exclusively for business purposes? So if HMRC were to come knocking, can you legitimately say that it is a business expense? And if you can, then it is more than likely an allowable business expense. But there are some expenses where they can relate to both your business and your personal. Most of these things are kind of like your mobile phone, internet costs, because obviously you use it in your home and for your business, and in that case, you can usually claim a proportion as a business expense and put a proportion as a personal expense. So you don't have to have 2 phones and 2 internet lines. Although if you did have a separate phone for work, then obviously that's 100% business. So I'll start with, I've just broken it down into the different categories that HMRC tend to put on for their tax returns. Then it's usually easier if you were to look at this whilst completing your tax return, it's sort of in the correct sections. So we start with travel costs. So you can claim for caravan and travel costs for any trips that are wholly and exclusively for work purposes. So obviously if you're going to meet a client, then that is, if you're going to meet a supplier, or if you travel into a training course that's in relation to the work that you do, or if you're going to a networking event that's for business purposes, then obviously you can claim that as well. The travel costs you can claim are parking costs. If you had to hire a car to go to an event, so say some of my clients go to trade events, so they'll hire a van because their car doesn't fit all the stuff in that they need. So they can obviously claim for the hire of the vehicle and the fuel that they put in that vehicle. And then obviously train, air, bus or taxi fares. If you have to stay overnight, then you can claim your hotel rooms. You can also claim your meals if you're staying overnight, so you can claim your evening meal and your breakfast. And if you don't have a vehicle in your business, so your vehicle isn't in your business name, then you need to claim for mileage rather than fuel costs. So you can only claim for fuel costs if the car is in the business's name. And the easiest way to know that is on your V5 document. Is it in you personally or is it in the company's name? If it's in the company name, then just claim mileage for that.
We've just got a question there, Sam, from Emma, and she's just said, do we need receipts for meals?
Yes, you need receipts for everything. So
if say I was going to a client meeting and I wanted to treat me and the client to dinner, am I able to claim for the whole amount or just my cost of the dinner?
So what would happen is you pay for the whole amount through your company, because it is a business expense, but it's not allowable for tax. So if you put it all through the company, half of it would be allowable, so for tax, your half, but the other half isn't. But it's better to put it through your company, because if you're a limited company and you withdraw that money, you're going to get taxed when you withdraw it to then pay for the client's meal. So if you pay for it through the business, we just add that little element back onto the tax comp before we come to the figure that will get charged for tax.
Okay.
If that makes sense.
Yeah.
Just pay for it through your business account and your accountant will sort it out.
Yeah, that's always what I do.
Okay, so this is just explaining the mileage costs and how you can claim them. So it all depends on the number of miles. So up to 10,000
you're welcome to log in if you want to learn anything about, expenses and pensions and all that kind of stuff.
Oh, hello.
I've just muted.
There we go.
It's all right. I thought she had a question there.
Yeah, but it sounds good anyway. She sounds like she's promoting the masterclass, so that's all good.
Thanks, Adrian. Right, okay, so what was I saying? Mileage. So it goes on the number of miles that you claim in the year. So it's in the tax year. So it's up to 10,000 miles, you get 45 pence per mile. Then anything above 10,000, you'll get 25 pence a mile. If you use a motorcycle, you get 24 pence a mile. And if you're super fit and you like to cycle everywhere, then you can actually claim 20 pence a mile for any business trips you do on your bicycle.
Shame I can't claim for running. I might be more inclined to do that.
No, sorry. Although I think you should, because it's more environmentally friendly, isn't it?
True, yeah, it should be incentivized.
Yeah, you definitely should. So the best thing to do is just to keep a mileage log, and then once you hit over your 10,000, you can drop it down to the 25 pence. HMRC are supposed to be reviewing these rates due to obviously the rise in the cost of fuel and things, but as of yet, these are what they are. Moving on. There we go. So next on to office, property and equipment. So there's quite a lot of things that fall under this category. So obviously you can have anything to do with postage. So if you're posting anything to clients or suppliers, any stationery that you need in order to do your job, Any printing, so this includes as well if you were to get flyers printed or business cards printed, then that comes under there. If you have to buy a printer and ink to print things at home, then that comes under. Computer software, so any software that you use within your business. I know as an accountant we have different cloud accounting softwares as well as like CRM systems, so it's anything that you need to pay for that enables you to carry out the services for your clients. Any subscriptions to online programs, so I've sort of noted there a few that come across. So Asana, Canva, if you use it only for business purposes. If you're to create, so I know some people like to use it to create birthday invitations and things, then what you can do is you can apportion it, so you can put part of it as personal and part of it as business. And then a lot of people are getting a nice little blue tick on the Meta Verified for a business account on Instagram and Facebook, and you can claim that as an expense as well. Web domains, so obviously that's self-explanatory. And then you can also claim for any books that are educational in your field. So if they enhance your knowledge within the business that you have, then you can claim them as an expense, and any insurances that you have as well. And I've just noted there, like I said before, the following are usually the ones that you claim a proportion of. So when you claim a proportion of, I tend to say for the internet, I say how many days a week that I work versus how, like the 7 days, so you can claim like 5/7 of a weekly cost of your internet if you work 5 days a week, for example.
We've just got a couple of questions come through, Sam. Can you open up the chat to read them, okay? Or do you want me to read them out loud?
I've got it here, hang on. So hang on,
I can read them if it's easier.
So if there are any differences for limited companies and sole traders, can you say? Yeah, I'll try and mention it, but most things come under the same expenses, apart from the one screen that I've got on now, that will differ. But I will try and remember to say, and if I don't, please just remind me. Yeah, so if you've got, like I know Emma, if you've got your cloud accounting software set up, so I'll just move the chat to there and see if it works. If you've got your cloud accounting software set up and all these expenses go through your business account, then yes, these will all be incorporated into being business expenses. If they are things that people pay for outside of the business and the personal account, but they are business expenses, then they can be claimed as well, as long as you've got a receipt. But it just makes it easier if everything is in your business account. Right, so where was I? So there, yeah, right. So use of home. So a lot of people now work from home. So you can claim a proportion of the running costs of your home as an expense. So there's two ways to do it. There's this way that's on the screen where you can, what I tend to do is get clients to tell me how much their electricity, heat and council tax, mortgage interest and water rates are for the year. And then if they have an office in their house, then we say how many rooms are in the house, and then we apportion it down to one room being used as the business. And then you work out how many days a week you work, and you divide the total figure by, I would do it by like 52 weeks, then divide it by 5 days if you do it like in the week, and then that gives you the amount. Once you have that amount, then if you compare it to HMRC simplified expenses, so for this one you don't need any backup or anything, you're allowed to claim this as up to £26 a month. So personally I calculate the cost, which usually the cost of running your home is more than £26 a month, and compare it to this, and I would put through the highest figure because then this saves you the most tax. Staff expenses. So unless you're running a pay-as-you-earn scheme, so you're processing payroll every month and submitting it to HMRC and sending out pay slips, then you're more than likely going to be paying a subcontractor for their services. So as long as the subcontractor issues you with an invoice for you to pay, then they're allowable expenses in your business. So these are just some examples of where people tend to use a subcontractor more than an employee. So a virtual assistant, social media manager, copywriter, sales strategists. So this obviously, as long as it's in relation to your business and you're not just getting somebody to help you with your general life admin. So, and under staff expenses, you can claim for any training courses. So these have to be training courses that enhance your skills in your current business. So it can't be that if you're currently, like, I'm an accountant and I decide actually I want to become a social media manager and learn how to do that, that cost of training wouldn't be allowable because it's not actually applicable to my current business. So as well, like, sort of under the training costs umbrella, then it includes like webinars, any group programs, so any sort of like business masterminds that you're in so that you can grow your own business. This will all be allowable expenses from HMRC. And
we just had a question, sorry, Sam,
Yeah.
off Karen there.
Oh, so if you don't issue invoices, then this should be enrolled as an employee. Yeah, so it's completely up to you. So obviously employing somebody brings a lot more factors than somebody just invoicing you, because you would need to have your employee contract, you'd have to think about holidays. If they earn just over £10,000, then you'll have to set up a workplace pension. So it's definitely a conversation to have with an accountant as to what the cost is involved in employing somebody, because it isn't just the cost of paying them. Whereas as a subcontractor, if they don't work, they don't invoice you. So it's all, you've got all that to consider. But the only way you can pay somebody without employing them or getting an invoice is through casual wages, and it's such a small amount every month. I think it's about £120, £23 a week you can pay somebody without putting them on payroll. So that was that. I hope that answers your question, Helen. Right, okay, so onto legal and financial costs. So this is where me and Rebecca come. So you can claim accountancy fees as long as it's in relation to the this business, then yes, you can claim your accountancy fees. Any bookkeeping fees, you can claim them. Financial advisor fees, as long as it's business related advice and it's not personal wealth advice. And then solicitors fees, as long as it's in relation to the business. So it can't be like if you're going to buy a house and you need to use a solicitor, unfortunately you can't claim that. And then marketing, entertainment and subscriptions. So any advertising costs for your business, so Facebook ads, Instagram ads, or if you pay to be listed on a certain directory online, as I know, like for a lot of tradespeople, they may be paid to like list on a certain website. For that, give me 2 seconds, I just need a quick drink. And then if you pay for somebody to do your email marketing for you, so write emails for you, you can claim for that. Website costs, so website costs will include the domain names, the setup of your website, the if you pay for like an annual fee for somebody to maintain it or do any changes to your website, then that is, and for the actual like hosting as well. Subscriptions, I've covered that before, but it's as long as it's like a professional subscription related to your business. I'm part of the Institute of Chartered Accountants. I have to pay them a hell of a lot of money every year. So luckily that is a business expense. And then any goods which market your company. So I've got some pens and notepads, they are allowable business expenses as long as it's got your name on it, so it's clearly shown. Or like, for example, like if you had a t-shirt with like your business name on it, then you can claim that as well. And if you have a brand photo shoot, so if you get any photos taken to be used on social media, your websites or flyers, then that's allowable expense as well. So the fun one, and the one that people want to know right now, as Christmas is looming, so gifts. So HMRC do allow gifts and they call them trivial benefits. They never used to, but they introduced it so that you can. So it applies to all your employees, and if you're a limited company, it applies to directors as well. So even if you're a limited company as a sole director, it'll apply to you. And you can give some gifts that are tax-free. But if you're a sole trader, then unfortunately it doesn't apply and you can't have any. I'm sorry. And one of the benefits of being a limited company, I know. So for a gift to be tax-free from the company, it needs to meet the following criteria. So it's got to be £50 or under, including VAT. So if it was like £52, then the whole thing is not allowable. You can't just say £50 of it's allowable and £2 not. The whole thing's got to be under £50. And you can't just give a cash gift, but you can buy a voucher. So that's fine. But one way to get around the £50 is if you wanted something that was like £100, but you could buy a voucher for that place, and you could buy 2 vouchers at £50, then you can go and spend the £100 voucher on what you actually wanted. So that's my little tip.
I like it, especially like you say, close to Christmas.
Yeah. So if you're a director of the company, the limit you can spend is £300 in a tax year. So obviously it's got to be broken down into the £50 elements, but in total you can spend £300. For employees, there's no limit how much you can spend on them, as long as it's broken down into the £50 per transaction. You can spend as much as you like on your employees. And the beauty of the gifts is they reduce your corporation tax bill, and if you're VAT registered and they've got VAT on them, you can actually reclaim the VAT as well. So you can gift anything, like as long as it's less than £50, you can literally gift anything. So you can buy some toys for your kid if it's under £50 and class it as your gift. It really is abroad. There is nothing off limits except cash. So it's well worth knowing about. And then parties. So you can claim back the cost of parties for your employees as long as it is open to all employees. And it's an annual event, so a Christmas party or a summer barbecue. It can't be like a one-off event like a retirement party or something. It has to be something that sort of just could happen every year. And the cost has got to be less than £150 per person. It's the same concept as the other one. If it was £151, the whole lot is not allowable, so it's got to stay under that £150. So it applies to online and virtual parties. So I know a lot of people now work from home. So if you were to organise something and say send a hamper to everybody who was going to join like a Zoom party, then that's allowable under the £150 per person. So I can just see some questions popping through. I'll just finish this slide and then I'll get to the questions. So you can also invite partners of the employees to your party as well. So that would mean it's £150 for the partner as well. So if you are a director of a limited company, if you're a sole director like I am, and I want to throw myself a Christmas party, me and my husband can go and enjoy our Christmas party and have £300 on the company to do it. So it includes all costs of the event, so food, drink, it does include alcohol, travel and entertainment, as long as it stays under that £150. So I'll just read the question. Okay. So you can't gift clients, it's gifting yourself as a director or an employee. So if you gift a client, then that's not allowable. That's what comes under the same concept as the taking the client out for a meal. So yeah, so if you're gifting an employee, you can give them like 8 £50 gifts throughout the year. You can go over the £300, but as a director, you can only take out up to the £300. What's it work if I want to do? Sorry, Emma, I'm not sure what you mean there. If you write it in the chat box, I'll come back to you. Right, okay, on to pension contributions and protection. So the rules for pension and protection will differ whether you're a sole trader or a limited company. So I've just broke it down into, first of all, if you're a limited company and then you're a sole trader. Obviously, Rebecca will expand on all of this, but from an accounting point of view, this is what you need to know. So if you're a limited company, then pension contributions can be used to reduce your corporation tax bill because they're classed as an allowable expense. So the pension contributions must be paid into a pension scheme that is set up by the limited company. And in the same terms for income protection insurance, as long as it's set up in the limited company, then that's allowable as well. So making the contribution directly from the limited company as an employer means that you save personal tax because you're not having to withdraw the money as, say, salary or dividend and then pay it into your pension. It's going directly from the company into the pension scheme. So that's why people would set it up under a limited company, as well as saving your corporation tax. And if you're a sole trader, then it depends if you're a basic rate taxpayer, so you pay the 20% tax, or if you're a higher rate taxpayer. So if you're a basic rate taxpayer, you're entitled to the 20% tax relief if you contribute to a personal pension. So if you were to contribute £80, HMRC top it up to £100, but this is done automatically by your pension provider, so you don't actually have to do anything yourself if you're a basic rate taxpayer. If you're a higher rate taxpayer, then you automatically get the 20% tax relief through the pension provider, but then you can claim an additional 20% relief on your tax return. So a £100 contribution, if you're a higher rate taxpayer, would be £60 from you, £20 from the pension provider, and £20 you would claim it on your self-assessment tax return. So it's still worth contributing whether you're a sole trader or a limited company. There's still tax savings to be had. 2 seconds. Sorry. This morning
always happens to me when I start talking for far too long.
I know. I woke up this morning feeling kind of nasal and coldy, so I don't usually sound this nasal either. I'm sorry. The kids and their germs, they love to spread. Right, so income protection payments. Oh, that shouldn't be on there, sorry. Well, what's this one? And not personally. Yeah, so income protection payments as a sole trader are not allowable because they're not a business expense. So then now I've covered a lot of the expenses you can claim. These are things that you cannot claim for. This is just a summary. Obviously, there'll be very weird and random things that you can't claim for, but these are things that people may think they can claim for that they can't. So obviously for caravan and travel, so non-business related travel. So if you're just going to the shops to do your weekly shop, even if it's in work hours, you can't claim this. Fines, so speeding fines, even if you're going to meet a client and you're late and you get caught speeding, so it's not allowable. And parking tickets are the same. So even if you're on business, something to do with your business meeting and it runs over, then you can't claim the fines. Clothing, you cannot claim for everyday clothing that you wear for work unless it is branded or it is protective clothing. So if you do a job where you have to wear a certain sort of protective clothing or high vis or something, then obviously you can claim for that. But you can't just claim for everyday clothing. Even if I have a lot of clients ask me, they're saying they're going for a brand photo shoot and they've just bought a load of new dresses for it. But I'm like, no, sorry, because you will wear that dress afterwards to go out. So it's not an expense. One way to get around it for that sort of scenario is if you were to rent. I know a lot of clothing companies now do like a rental option. So if you were to rent something specifically for a business event, then you can claim for that. So if you rented a suit or a tux or something for a business event, you can claim for that. Staff, so unfortunately you can't claim for nannies or childcare, which I really wish I could, but obviously I can't. I don't see how I can work and have kids at home, but you know, HMRC say no. I did have a client recently whose accountant actually told them they could, and then they got into all sorts of mess, but really you can't. So I don't know why I've got legal and finance costs for staff. Fines for breaking. Oh, so yeah, so if your staff were to break the law and they get a fine, then you can't claim for that either. So bank, credit card and other financial charges. So you can't claim as a business expense a loan repayment, overdraft repayment or finance arrangements. You can claim interest. So the interest element of the repayment is allowable expense, but the actual element of repaying the loan isn't. And then marketing, entertainment. So entertaining clients and suppliers, like we mentioned before, you can't claim for them. You can claim for your portion of the entertainment, and event hospitality as well. So that's the same sort of concept. If you throw a party for your clients, then you can't claim for that either. Throw it for your staff though, and you can't, so that's okay. And then I've mentioned training courses as well. If they were to start up a completely different business, then you can't have that either.
Am I right, Sam, in thinking that, you know, a lot of people obviously took out like bounce back loans and things like that over the last few years? I'm right, aren't I, thinking that the interest accrued on the bounce back loans is actually a deductible expense as well?
Yeah, so yeah, they
Yeah.
are. So the interest on any sort of business loan, or if you get like a HP agreement to buy a vehicle for your business, the interest element is allowable and that will come off before we calculate your tax figure, but the actual element of it that's repaying the loan doesn't.
Okay, thanks.
And then any questions? Oh, I know we've had some throughout, but has anybody got any more? Then remember, there is actually no stupid question at all.
No, I was just keeping an eye on the chat bar. Nothing more has come through. Obviously, if there is any questions that crop up, please do ask them. Or if anything crops up afterwards that you think about, you know, get in touch.
I'll pass over to Rebecca now and we'll stop sharing.
Fantastic. I will just get my slides ready and then I will start sharing my screen. Can you all see them? Have they come through okay? Yeah, perfect. That's great. Thank you. So yeah, thanks for that, Sam. Obviously, lots to digest there. And I'm going to talk a little bit more, obviously, about the financial planning element. And the key kind of things we're going to focus on, as I've said, is the protection and pensions. Obviously, there's a lot more to it, but that's what we're going to focus on today. So again, just a bit of housekeeping. This presentation is for information and guidance purposes only and doesn't constitute financial advice. If you do need advice, please seek that separately. So can anyone else relate when it comes to managing your personal finances and maybe your business finances initially? If you don't have an accountant, I completely understand how business finances can be massively overwhelming. But I also, probably because I obviously speak to clients on a daily basis about this, financial planning personally can also be overwhelming because there's a lot of things that we know we should be doing or we hear about, but we're concerned that we're not doing, or we're overwhelmed by the thought of doing them because we don't know where to start. Or maybe it's a case of you know that you should be doing something, should I say, you don't know where to start, or you haven't got the time, or it's kind of full of loads of jargon that's a little bit overwhelming and quite complex. So often, sadly, people decide, instead of seeking help, to kind of bury their head a little bit in the sand. And I completely understand, as a business owner, when you first set up your business, your main focus is driving that business income, driving that revenue, and just making sure everything ticks over nicely. And then you get to that point, hopefully a couple of years down the line, where things are feeling a lot more steady and you can start trying to predict, okay, I'm fairly confident now what my revenue looks like, what my expenditure looks like, and what I can then personally withdraw from this business to keep the business sustainable and to support my personal financial arrangements. So this is just a reminder, you know, at the end of the day, if you are a sole trader or a limited company where you are maybe the sole director, your business income and revenue are very much direct. You and your business finances and your personal finances are very much interlinked, and you are at the center of them both. Typically, yes, in your personal finances, there may be another part. It might be that you have a partner that obviously contributes towards your personal financial planning, but very much at the start of your new business, especially if you are the kind of the sole person driving your business, you are going to be the linchpin between the two. So no matter what the financial objective is, no matter whether it's a short-term goal or a long-term goal, these are the two things I recommend anyone focuses on. The things that matter, so the things that are important to you, what you value most, what you enjoy doing, what you want to spend your money on, who you want to spend your money on, how you want to spend your money on. They're the things that matter to you, and only you know what's important to you. Obviously, what's important to me will be different to what's important to Sam and, you know, everyone else on the workshop. But really, any financial goal should be focused on that. What is important to you, not anybody else. And then the second part is what you can control, because at the end of the day, there's no point worrying about the things that we can't. And the main things we can control are our income, our savings, our expenditure, and our investments. We can't control the government interest rates. We can't control mortgage rates. We can't control, obviously, whether a war breaks out in, other countries, and the impact that that has on the stock market and possibly any of our investments. So I fully appreciate that it's important to understand the potential impact these external issues may have on your own arrangements, but it's really important that you don't put too much emphasis and you don't kind of put too much energy into the things that you can't control. So what we're going to talk about, like I've said today, is the two key things, and that's protecting yourself and your plan, and also then retirement planning. So knowing your numbers is really important. So talking about what you can control, if you know exactly or roughly what it is income-wise you're receiving from your business every month, you also need to understand what it is that your personal lifestyle is costing you. So this will help them maybe establish, okay, how much do I need to draw from my business to fund my personal lifestyle? And it may be that the case that you end up realizing, oh, I'm drawing maybe too much at this moment. I don't need to draw that much, save myself some tax. Or it may be the case that actually you want to increase what you're drawing to fund your personal lifestyle and to fund some of your personal goals as well. Because although certain things can be worked towards through your business, as Sam has suggested, like pension contributions, other personal investments can't always be funded through the business. So it's important that you understand what your personal financial goals are and how it is that your business can be used to work towards them. So as you can see there, I've just put down an annual expenditure analysis spreadsheet just to give you an indication of what you might want to think about when assessing how much does my current lifestyle costs. And everyone is going to have the fixed expenses, so their basic essential costs, your rent, your mortgage, your bills, the council tax, possibly your vehicle, if it's getting you to and from work, food. You're going to know roughly what those fixed costs are. And then on top of that, you're going to have your discretionary and lifestyle expenditure, and everyone's will vary. But if you haven't done this before, I would highly recommend spending a bit of time over the weekend and just looking back over the last 3 to 6 months and maybe doing this analysis for yourself to see what your current lifestyle is costing you. And the reason why I suggest doing it on an annual basis as opposed to just a monthly basis is because things crop up, don't they, over the year that may be one-off. It might be birthdays, Christmases, having your hair done, having your nails done, things that throughout the year you're going to want to cover the cost of, but not necessarily are they a regular monthly expense. So that's why I would always recommend looking at the total cost over the year as opposed to just looking at each month in isolation. And what you want to understand is, how much is my business cost costing me? So you want to have a good breakdown and a good understanding of what your business income and expenses are, and then a good breakdown and understanding of what your personal costs are. And if you haven't already, I'm sure Sam would support me in this top tip. I would highly recommend that you have a separate, as a minimum, a separate current account for your personal expenditure and a separate current account, separate savings account for your personal goals. And then on top of that, having a separate business account. If it's got one where you can have multiple pots within it, then great, you might not need a separate savings of one. But I would always say you want to have a current account so you can see your kind of incoming and outgoings, and then a minimum separate business and personal savings account. Would you agree, Sam, on that one? Yeah. So when it comes to savings, these are the things that you might want to think about. Obviously, we can go into a lot more detail, but I'm trying to just kind of summarize some of the key things that you're going to want to think about to give you financial resilience. So this will hopefully give you peace of mind and comfort. And these are saving goals that you might not yet have reached, but hopefully you can work towards them. So from a business perspective, you're going to want to make sure that you've got your tax saved. If you're a limited company or sole trade, obviously the things that you have to save for tax-wise will vary. But as an example, if you're a sole trader and you know roughly you're going to be a basic rate taxpayer, you're probably going to want to save roughly about 20% of your income in a separate bank account, so you know you're going to have the money readily available to pay that tax bill. If obviously you're a limited company director, then you're going to have to consider having your corporation tax saved, but then you're going to have to also have your personal tax saved as well. So it's really important that you understand that there's two tax liabilities if you're a limited company director, and it's important that you have a saving pot for each one. On top of that, in your business, again, to make sure that it's hopefully going to be able to withstand any sudden shocks, you would like to have 3 to 6 months expenditure saved in your separate savings account for your business. And then again, because your savings for your personal expenditure are separate to your business costs and savings, you'd want to also have ideally 3 to 6 months personal expenditure also saved separately. And then in your business, you're going to want to maybe consider saving for development of your business, whether that's courses or technology and investments. But maybe you might want to start saving X amount per month, percentage wise, to work towards developing the business in other ways. And if you've got anticipated capital needs in your business, again, that's going to be money that you're probably going to want to start to save and keep separate to your income and expenditure. And the reason you'd want to keep that in cash as opposed to investing is you won't want to take any risk with that money if you know it's for a set purpose within a kind of short-term time frame. And the same for your personal expenditure. So you've drawn the money out of your business account, it's landed in your personal account. You're going to want to think about, what am I going to want to save for this year? So if, let's say, you've got holidays coming up, you know you've got annual insurances that you have to pay for, birthdays, you might want to start saving monthly for those things. So I personally use, and this isn't a recommendation professionally, this is a personal recommendation, I use Starling, and I have little saving pots within my personal account so that I can allocate a percentage amount each month into those separate pots, like I said, for Christmas, birthdays and holidays. So I know I've got a little bit set aside for all those things because they're important to me and I'm going to want to spend money on them throughout the year. And beyond that, then, if you know that there's a goal that you want to reach within the next 3 to 5 years, as a personal goal, whether that might be moving home, it might be buying a second home, it might be that you want to do a renovation to your home, you might want to fund your education costs, you might want to set up a new business. If there are anticipated capital requirements that you know you don't want to take any risk with that money for, then again, you might want to consider putting that in a separate savings account so that it's ring-fenced and moved away from your general expenditure and income. Does that make sense? Has anyone got any questions about that? Any questions come up, Sam? Just because I can't see the chat.
No, I'm keeping an eye on the chat, don't worry. Good,
that's great. So hopefully you can understand how having that separate savings account for both business and personal, and understanding what your anticipated expenditure is going to be throughout the year, that's going to provide some financial resilience and protection for the unknown. So if, let's say, if you haven't quite reached that, and if you want then added security and added protection, the one thing you can also consider is taking out a protection policy. Now, we're going to talk about personal protection. There are different options available if your business grows and if you then end up getting maybe multiple shareholders and directors within the business and key workers within the business. I'm not going to focus on these today. I'm going to focus on what you could take out as an individual. Now, personal income protection is there to protect you as the main kind of resource, you know, in your business, and the main kind of income generator, possibly for your family. It might be that you're the sole income generator for your family, or it might be the case that you have a partner and you're both obviously contributing to those joint household costs and financial goals. But it's there to protect you and your family should you be unable to work as a result of accident or illness. So if all of a sudden you can't work because you've had a car crash, sadly, or you've had you know, a mental health issue, or you've broken a leg and you can't do your job, having a personal income protection policy would allow that plan to pay out if you couldn't carry out your job. And the amount that you would want protection for will vary depending on your circumstances, and also will vary depending on what it is income-wise you currently have. But if you couldn't do your job, and as a consequence, obviously, your financial position, whether you're an individual or as a couple or as a family, would be you know, it would be a shock to your financial position. Income protection would help absorb that, because you would claim on the policy and it would pay out a monthly benefit whilst you were unable to work. You then know, if that's the case, your bills are still being paid for, and hopefully you can still work towards those financial goals. So hopefully then you're not going to have to sacrifice your other goals because you're not able to work. So like I said, there's kind of two key parts to personal protection. There's the income protection, and then you can also get life and critical illness cover. Life cover obviously protects you if you were to suddenly die, and critical illness cover would protect you if you were diagnosed with a specific critical illness. Now, a lot of people have this type of cover in place if they have mortgage debt or they have a family, because they'll want to make sure, obviously, if anything was to happen to them as an individual, that their family would still be financially secure. But as a basic minimum, I would highly recommend anyone who is working and you have an income, and it's important, you know, to the household, that that income is protected. So there's two ways in which you can actually secure income protection. If you are a limited company, you can secure what's called executive income protection. And that means that the policy is actually covered and paid for by the company. If you are a sole trader, then you would have to take it out in your own name, and it would be classed as a personal protection policy. So I've just tried to highlight some of the key differences with this table. I appreciate it's quite small, but hopefully you can see that there's a difference. The benefit of putting it through the limited company is that you can actually claim a higher amount. So the coverage is higher. You can typically have up to 80% of your income protected if it goes through the business, as opposed to up to typically 60 to 65% if it goes through, if you're sole trader and it's a personal cover. When you are a limited company and you put it through the business, you also have the added benefit of being able to include pension contributions and national insurance contributions if you wanted to. You also have the benefit of it being a deductible expense, as Sam has said. If you are a sole trader, you can't sadly claim it as a deductible expense. But the benefit is when the policy pays out, if you are a sole trader, it is paid out tax-free, and the money is yours to do as you please. If it's owned by the business, so it's paid out to the company, then the benefit will be paid to the company tax-free, but then when the benefit is paid on, obviously, to yourself, it becomes taxable. So there's a couple of pros and cons, you know, to each scenario, but basically it's a no-brainer if you want to make sure that your income would continue if you were unable to work. And again, the waiting period. So depending on your financial position, you can choose whether or not you would want the payment to kick in after, let's say, 1 week, 1 month, 2 months, or 3. So again, depending on maybe how much you have in the background in terms of savings, or whether or not you have another income in your household, might dictate how long the deferral period is before you make a claim. Does that make sense? Hopefully, I appreciate there's quite a lot of information on that slide, but hopefully have I clarified the difference between executive income protection that's done for the business and personal income protection that's taken out as an individual. Is there any questions at all?
Nothing in the chat.
Okay, lovely. I will carry on. So we'll move on to retirement focused. And if you just took a couple of minutes now to think about how much income per year do you think you will need in retirement based on the current cost of your lifestyle and anticipated future plans. So I know that's probably quite a hard question to answer, but it's really important that you actually do at some point answer this question, just so that you can start thinking about, okay, if I know I want to live X kind of lifestyle in retirement. I want to go abroad, or I want to stay in the UK. I want to buy a bigger house. I want to buy a smaller house. I anticipate working part-time before fully retiring. I anticipate retiring at 55 or 65. You will know roughly at this point in time what maybe you would like your retirement to look and feel like. I appreciate you're not going to maybe be able to answer the question with precise detail. As you get closer to retirement, this question becomes a bit easier to answer. But it's really important just to have a think about what it is at this stage you anticipate, mainly because you want to start building a plan now to try and build a pension pot big enough to fund that lifestyle. So at the moment, you may be aware that everyone's entitled to a state pension if you make your national insurance contributions. The current state pension as of this year is £203 a week, so £10,636. When you think back to the question I've just asked, I anticipate probably that the answer was going to be more than £10,000. Most people's lifestyles cost them more than the government state pension. So I'm sure if you can get it under that amount, fair play to you. But for most people, it's typically double, if not more. But it is important. The state pension is a really valuable benefit because it's guaranteed and it is paid weekly until you die. So it's a really valuable income source in retirement, but it's probably not going to be enough to fund your retirement solely. You're probably going to have to make personal pension contributions. So we're going to look at this in a bit more detail. So I use cash flow forecasting software with my clients to help them see a visual representation of their future plan. Now, this is a really basic one, and the chances of somebody's life being this linear is not likely, but I'm hoping it will allow you to see on a very basic level the difference between having no pension and potentially contributing on a monthly basis, and the impact that that will have in terms of how sustainable then your income will be once you actually retire. So this is assuming this person earns about £40,000 a year. Their expenditure is about £30,000 a year. So we're assuming that this person is saving only, so not investing via a pension, just saving, putting in a cash saving account, the difference between their income and expenditure every year. And then the state pension kicks in when they're 68. So as you can see then, they will have approximately enough savings to keep them until they're about 77. And this is assuming that they save everything over their expenditure, which again in the real world is highly unlikely. And in the real world, this line is like this, up and down, and people's income can often fluctuate unless you're in a guaranteed salary, you know. But even if you are in a salaried position, the chances of you staying in one job for your entire life is very limited, as we know right now. So I've just then done the same forecast, but based on somebody making £150 a month contribution. So here you can see everything else is remaining the same, but by making £150 payment into a pension, you can see then that that sustainable income is going to last a lot longer. So they're going to be able to survive until roughly 82 years of age before that income would stop, and then there'd be a deficit between their expenditure and their state pension. And this one is assuming a £300 a month contribution. So as you can see, it's improving the sustainability of that income in retirement, meaning obviously they've got more security. And if, which is going to likely be the case, their expenditure, you know, is more than 30,000 one year, it's less than 30,000 the other, they're going to have a larger pot to fund that retirement lifestyle with. So what I wanted to do, just to give you an indication, and the software I use is really quite clever and will allow me, based on your personal circumstances, to give you an indication of what you need to be saving for each month to hit a potential retirement income goal. And I just wanted to show you this example. Like I said, everyone's circumstances are different, but this just gives you an indication possibly of what maybe you might want to work towards if you are looking to start saving on a monthly basis into a pension. So we've made some assumptions, as you can see on the left-hand side. So we're assuming that the current pension pot size is £10,000. So not a huge, 10,000? Yes, all of us. No, 100,000, sorry. I was like, I couldn't even read my own writing. We're assuming that it's £100,000 at the moment. So this person's already got £100,000 in pension provision. we're assuming that there's a growth rate of 3% every year and inflation is 3%. So growth rate of 6% and inflation is 3%. So the actual real return is only 3%. As we know, inflation is a lot higher at the moment and growth rates on investments will fluctuate. So these are, like I said, just assumptions just for the purposes of this illustration. What we're trying to achieve is a regular income of £1,250. Now, remember, when you are in receipt of pension income, it's paid gross, but it is taxable. So depending on what other sources of income you may have, say it's a state pension, or you have other, say you've got a pension from a previous workplace, you may have guaranteed income from that source as well. So this is to try and achieve a gross income of £1,250, which once taxed would only produce an actual income of £1,000 net per month. And as you can see, in order to achieve that and for the income to be sustainable for 30 years, so if this person retired at 68 and then lived for 30 years, so obviously it would be sustainable until 98. Again, I appreciate not everyone would want their income to last that long, but, you know, working towards the age of 100 is not probably, you know, unrealistic based on how long people are currently living for. You can see that that person would need to start saving £650 a month. That's gross. So like we've said, you do get your relief on top of this. So your net income, your net contribution may be lower, but just to give you an indication, that's the kind of amount per month you would need to save over the next 30 years to reach a pension pot size of roughly this. Now, I've also in the background assumed that this person is invested in kind of balanced investments, so middle of the line, not too adventurous, not too cautious. And at that point, you should hopefully have enough in your pot to give you a gross monthly income in retirement of approximately £1,250. Does that hopefully make sense? And it doesn't, like I say, this is just an example to hopefully help you understand the kind of key components when it comes to pension planning. You want to consider what you've currently got available to you, where you'd like to be, and how you can fill the gap. And obviously that gap will be different for everyone depending on what their desired level of income is in retirement and when they want to retire. There's a lot of things we can't control, growth rates, inflation rates, but understanding where you are now and where you'd like to be is really important as a starting point. So how much can you contribute to your pension? Now, you may be aware that the government changed the rules on this. So as of this year, you can actually contribute, the maximum you can contribute is £60,000, but it's actually limited to 100% of your UK relevant earnings. So if your salary is less than 60,000, so say you are a sole trader and your net profit is £25,000, then that's the maximum you could actually contribute to that in that year. You couldn't actually go on to contribute £60,000. Even, let's say, if you had the money in a separate savings account, you can only contribute up to the highest of your relevant earnings, or £60,000. If you don't earn anything at all, then you can still contribute to a pension, but the maximum you could contribute net will be £2,880, because once it's grossed up, so you'll still get a basic relief on that of the 20%, the total amount into the pension would be £3,600. So as Sam's previously explained, you get tax relief on pension contributions, and you get the relief at the highest rate of income tax you pay. So if you are paying 40 or 45% tax as an individual, you will get that relief on your pension contributions. So it's a huge boost to your retirement savings, and it's the most tax efficient way to save for retirement. And as Sam has said, you might identify in your personal arrangements what you want your retirement goal to be, and then you could use your business via a limited company to make the pension contributions for you. So not only then are you going to be working towards that personal goal, you will also be doing it in a tax efficient way, because the cost of that pension contribution can be used to reduce your corporation tax. And even if you're a sole trader, as you've seen, you'll still get the tax relief applied to your contributions. So if you run your own business, as Sam has identified, then the contributions are not restricted by the relevant UK earnings rule. However, they must meet the wholly and exclusively requirement to receive the tax relief. And it's just important to note that dividends do not count as relevant earnings. So if you are a limited company director and you take a salary and dividends out of your business and you want to make a pension contribution, a personal pension contribution, you would only be able to contribute up to the amount that you've withdrawn as salary only. Whereas if you make it as an employer contribution through your business, you're not going to be restricted by that level of contribution. If you're a sole trader, it's typically your net profit. That's going to be the maximum that you would typically be seen to be able to contribute to a pension. And the other benefit of making an employer contribution is not only will you get corporation tax relief, but also you don't pay national insurance on the employer pension contribution as well. So that's another real quick win in terms of savings for your business. And just to know, obviously, the tax relief is normally given in the accounting period that the contribution is made. So in summary, obviously, like I've said, focus on what is important to you, focus on what you can control, maximise your income, available reliefs and allowances to make your money work harder for you, build a financial plan that's unique to you and your business and personal goals, and seek advice if you want support piecing this all together. But is there any questions on that? I appreciate, like I say, when it comes to pensions, it is quite complex. So I know there's quite a lot of moving parts to it, but I'm hoping you've clearly identified some of the benefits of understanding where you are, where you want to be, and how your business income can support you in terms of pension contributions, or if you're doing it as a sole trader, why the benefit of doing it that way is also there. I'm just going to stop sharing now. Is there any questions at all about that?
I don't have a question, but I just know that from you doing so Rebecca sorted all my pensions out for me. And from Rebecca showing me what I want my retirement to be like, and for me to be able to start contributing up to that level so I get there, it's like a great goal, because maybe I can't put it away right at the moment, the amount I need to, but I know that that's something I can aim for. And I can, like, obviously the later I start doing it, the longer it'll take as well. But it's just knowing that, because I think I was just thinking I need to contribute to a pension, but I just didn't know how much I realistically needed to put into it. So I think that was like so helpful.
And I think that is a question a lot of people want to know. How much is enough? Like, it's a key question for most people, whether it's a retirement goal or, like you say, another personal financial goal. And also for yourself, Sam, as well, you had, if you don't mind me sharing, quite a few different pensions with a number of providers, didn't you?
Yeah.
So not only did we establish how much you wanted to contribute, we also actually streamlined your arrangements, didn't we? So we made them a lot easier to manage, but also we put them in a more competitive position as well, which hopefully is going to make achieving that retirement goal that little bit easier. So like I say, with pensions, there is a lot to think about, but that was something that we did together so that your money is, again, going to be working that a little bit harder for you to make that retirement goal hopefully easier to achieve.
Yeah, definitely. I just feel a lot more happy that it's just all in one place. And I'm not like, because I forgot about a couple, didn't I?
Yeah. Which is so typical. If people have moved around and had multiple jobs, like, it's so easy to think, oh, and then, yeah, and again, that's why a lot of people bury their head in the sand, because they're like, oh gosh, but as you know, I did all the heavy lifting for you, didn't I? I made it hopefully that little bit easier. And now, like you say, the ease of management going forward is going to be much simpler, and you can just focus on building that, like, retirement provision, can't you, in an easier and cheaper place.
Yeah, definitely. Yeah.
Is there anything else at all, guys? I'm hoping everyone's really enjoyed it, or maybe not enjoyed, but at least found it helpful, useful, and I've got some kind of practical tips to take away. As we've said, you know, if there's anything at all that we can help you with off screen, then please reach out to us. Hopefully you've seen all our details, but if not, obviously, our email addresses, mine is just rebecca@1111financial.co.uk, and yours, Sam,
is sam@harmonyaccountinglimited.co.uk.
And I'm sure you'll be able to find us on socials if a DM is easier. But thank you so much, everyone, for coming along. I really appreciate you listening. And, you know, we hope you've got from it what you wanted to. And we're going to be doing some more of these, so please look out for them. I think next time we're going to maybe focus on some of that kind of cash flow forecasting, aren't we? And looking how you can be really strategic in your business when forecasting what income, expenditure and whatnot you need, and also then in your personal life too. So look out for the details of that one, guys.
Yeah, thank you.
Well, thanks very much, everyone.
Bye.
Bye.